we'll talk about the services at the end.
Sure.
Okay, because that's a long conversation because there's a lot of services in the phenomenal.
Okay.
And I'll give you a website that you can go to where you can actually download a free account and play with the service.
Sure.
Okay. So the first question that people ask is, what am I buying and how much does it cost? Okay. Very good question. So what you're buying is you're buying a franchise. That franchise is unlike Tim Hortons because it's not a physical structure. You're buying a territory. Okay, so you own a territory. That territory has 3,000 to 5,000 small business prospects in that territory that qualify. Our market is a small business market. Companies that have between 1 and 100 employees, ideally 1 to 25 is really our sweet spot. Okay, so that's what you're buying. You're buying the right to market the services in that territory. But you're not going to do it yourself. You're going to hire a company called Edge of Command who will actually market the services on your behalf. Wow. Just like you would hire a manager to run your McDonald's. So you're buying a turnkey business. Okay, and that's why so many professionals are buying these franchises, because they can continue doing what they do and have passive income generated over here from the franchise, which is managed by Edge of Command. Okay. Cost of the franchise is $100,000. And the way the numbers roll out is you're going to have a note for $100,000. That note is going to have the following terms: 10 years, interest of 1.2%. So over the 10 years, that's $12,000. But you're going to prepay that $12,000 over 3 years. You're going to pay it up front. You're also going to pay $14,000 of startup and marketing costs. So that's $26,000 of cash you're going to pay over 3 years up front. And then on the back end, you got a note due in 10 years for $100,000. Don't get hung up on the note, because
the note's for $400,000?
The note is for $100,000. But I'm going to show you how after 3 years the note is going to be retired. A number of exit strategies for the note. Okay. So to summarize the numbers, you're going to pay $26,000 of cash over 3 years, and you're going to have a note for $100,000. Okay. So the payment's going to be 10, 10, and 6. Year 1 you pay 10. Year 2 you pay 10. Year 3 you pay 6. Now, in terms of why you get this big deduction when you buy an Edge franchise, just think of it this way. When you have a business, there's certain expenses you can deduct. Simple. With Edge, the expense that you can deduct is the cost of the software license, which is when you combine the marketing cost and the software license, it's about $109,000, roughly $110,000 that you can deduct against your income. Why? Because $93,000 of the cost of the franchise qualifies as what's called a Class 12 asset. Class 12 asset is an asset that has some unique characteristics. The most important characteristic is the ability to write it off 100% over 2 years. 50% year 1, 50% year 2. Okay? And then you have your marketing costs that you can write off 100% in each year that you pay, because you're going to pay that $14,000, $7,000 year 1, $7,000 year 2. Okay? So how the deductions translates into tax savings is as follows. For every $1 invested, you're going to write off about $5.50 against your income. That's going to generate roughly $2 of tax refund. So a double. Now, the assumption we're making is that you make $100,000 or more. If you make less, that's a different conversation. Okay? So for every dollar invested, you're going to get $5 of deductions, give you $2 of refund roughly. In year 1, you're going to pay $10,000, and as a result, you're going to be able to deduct about $55,000 against your income, giving you a tax refund. Here in Alberta, the number would be about 21, not 26. This is based on Ontario, right? Year 2, you pay 10. You get 55. Same thing, so you get another refund. Year 3, you pay 6. You get very little deduction. You actually lose a bit of money in year 6. So the net result is after 3 years, you've paid 26, but you've got about 52 in tax refunds. So it'll be a little less here, maybe 46, right? But these are round numbers. Gives you a good indication. The numbers are going to be very close to this, depending on your exact income and your province. Okay. So again, actual numbers are going to vary, right? So far, so good.
Now, when you say I'm buying a franchise, am I buying this franchise? Am I buying it?
You personally.
Okay, so it's personally going to be mine.
Yes. So you personally will write a check, sign a contract that you're buying, just like you would go buy a Timmy's. You're buying the franchise. Okay, so now in terms of the note, I want to explain this clearly.
Okay.
And the way to do this is to make sure you understand what the real intention here is.
Okay.
Why are they making this opportunity available? Why is Edge available?
I would say it's to raise money.
Right, exactly. It's to raise money for a startup technology company.
Right.
And share all the services with you that they offer.
Yeah.
But also more importantly is the way that they're raising money through this franchise structure, selling franchises, allows them to keep, at the end of the day, the majority ownership of the business, and the franchisees will keep a minority interest in the business.
Okay.
Okay, and I'm going to show you how this happens.
Okay.
Compare that to traditional means of financing, say going to venture capital or private equity. Typically, they want 85-90%, you keep 10. That's
right.
typically how it works.
Yeah.
This allows Edge to keep 80-85%, and the franchisees keep roughly 20%.
Okay.
And I'll explain how that happens. So that's the real intention here.
Okay.
And the intention is to sell this company at some point.
Okay.
Is to build up the user base significantly enough so that it becomes attractive to a Google, a major player out there, a Dropbox, who says, we want this company because you have 3, 5, 10 million users. There's value in that.
Yeah.
Okay? So, in terms of the note, one of the options available, and there are many options, but one of the options available is an option that was actually utilized in the Prospector
Okay.
case. There's legal precedence for it already. CRA already accepted it.
Okay.
So I'm going to talk about that option.
Sure.
Okay. Although there are others. So, well, let me talk about the first option. First option is simply long-term revenue, where your franchise generates revenue every year. A percentage of that revenue goes to paying down your note
Okay.
automatically. It's built into the contract.
Okay.
The second option is where, like I said, a Google or a major player comes along and buys the company. Your interest in the company will generate so much profits you can use those profits to pay off the note.
Okay.
Keep the difference. The third option is where the franchisee, or franchisor rather, would contact all the franchisees after 3 years and say, we want to buy back your franchise. So the question is why? Why would they want to buy back your franchise? I'll answer that in a minute. So they're going to offer you 126,000 shares valued at $1 for your franchise because you paid 126,000, right? You had the note for 100 plus the 26 of cash,
Yeah.
so 126,000. So they're going to give you 126,000 shares valued at $1 in Edge, the franchisor.
Yep.
You then take 100,000 of those shares and pay off your note. So now they've just received 100,000 of the 126,000 shares.
Yeah.
Okay? You're left with 26,000 shares. So here's what's happened after 3 years. You paid 26,000. You got that back, plus an additional 18 to 26,000.
Yeah.
You've paid off your note,
Yeah.
and you have 26,000 shares in a real company, in a going concern.
Which was valued at $1 then.
Right. The value of those shares, we don't know what they're going to be in year 4, 5,
No,
and
we
6
don't.
when the company sold. It could be
Right.
3, 5, 10, who knows. But the intention is for those shares to have significant value appreciation over time because that's the exit strategy for the founders. Okay? That's their exit. So, you invested in a business, you got your investment back, you created new cash flow that you didn't have before through tax mitigation, you paid off your note, and you have 26,000 shares in a real company. Okay, and we'll talk about what, in what way those shares could be significantly increased in value over time.
Sure.
Okay. So again, just to recap, what you're buying when you buy an Edge franchise. Okay. First of all, you're buying a defined territory in the U.S. There's only 4,000 franchises. That's it. We've sold 2,100 so far. Okay. Why the U.S.? Because the U.S. is a much bigger market. If you look at the number of companies that qualify as a candidate for the services we offer, there's about 20 million companies in the U.S. That gives us 4,000 franchises, because 5,000 companies times 4,000 franchises is 20 million compared to maybe 400 franchises in Canada.
Yeah.
So they're just focusing on the U.S. market right now. Okay. Each small business in your territory would have between 1 and 100 employees.
Yeah.
And your franchise is going to sell software to these small businesses.
Okay.
And again, you will not be selling it yourself, but you're going to have a mandate. Now you're going to give a mandate to Edge of Command, and they're going to manage your franchise and sell the services for you. They're going to give you quarterly updates via the Franchise Association intranet, and your obligation is to read those updates on a quarterly basis.
Sure.
Okay. So now we're going to talk about the services. Okay. There's two distinct services. The first one is cloud-based, and that's where you're a small business, you got one computer, you're a single lawyer, accountant, what have you, and you want to have your data backed up every night automatically. So you have a cloud account. The amount of space you have just depends on how much you want to pay. $9 a month, $20 a month, $30 a month, what have you. So that's HighShare Cloud. That's where you simply have a virtual backup. It's encrypted, it's secure, because security is important to small business as much as big business, but they just don't have the financial resources to have an in-house IT department. Okay?
Exactly.
So that's one. Then we have another service for companies that may have multiple computers, say 10, 15, 20 computers. We would deliver a physical server to their office. That server would be connected to all the computers, and that server is fully loaded with some really cool software. One of which is an automatic backup functionality, which allows all the computers to be backed up every night to the server,
Yep.
and then from the server backed up to the cloud, so you have a double backup. In addition to that, you can send email in a secure encrypted fashion via SSL secure
Okay.
line.
Yep.
Okay, so what's really cool about the email functionality of HighShare is, for example, I can send you an email and I can put parameters and restrictions around that email. Yeah. Want to take that?
Yeah. You want to pause that?
Pause? Sure.